All right, guys, I got to open up the last page for this show from the investment playbook. Okay, the rally, I know it's long in the tooth, but is that a good reason for it to come to an end? Now, listen, I get it when the mavens call for these occasional pullbacks and they say it's always healthy. Why this long string of days without even a 10% correction scares a whole lot of people. But the fact is, would-be fence sitters, let's be honest, right? If we had a 10% correction, they wouldn't jump in. The professionals would, but these other guys wouldn't. Just so you understand where we are. Your median time period between 10% corrections, usually 121 days, average 273 days. Currently, we're at 563 days. Although the record is around 1,800 days, if that happened again, we're talking October 19th, 2017. Wouldn't that be nice? All right, now, for many in and out of the market, it's all about when we get the real correction. Forget about the pullback, right? And that's what I'm going to do for you right now. I'm going to handicap the risk to the stock market. Now, this is my table here. We're talking about the potential items that could happen, short-term risk, long-term risk, and the degree of impact that I see happening. First, let's talk geopolitical. We always talk ISIS. I think it's mostly a short-term thing. If we could not stop them, if they somehow were to start to regain territory, I think it'd be at least a 10% impact. Russia, of course, is much deeper. It's short-term and long-term implications. In fact, worst-case scenario, a pullback in our market well more than 20%. The Federal Reserve, I'm telling you, I think this is a short-term thing. When they finally raise rates, I'm not saying it can't be a sharp move down 20%, but I think it'll be 3 months or less. China's economy. China, from day one, has been the straw that stirred the global economic drink. Their economy has slowed somewhat. It could hurt us, although I think it'll be short-lived because somehow they will come up with another stimulus plan. How about our own economy? That's short-term and long-term risk. I mean, first we're talking deflation, recession. We need to get on track. We need to get on track. And then, of course, ultimately, the market simply being overvalued. I think that's more of a longer-term problem. When we do get to that overvalued spot, yes, we will get a correction. So let's talk about this, guys, because everyone's always trying to handicap this thing. Matt, I want to go to you first. You see the table up there. I want you to tell me where you think I'm wrong and how it really should matter to investors.
I don't really say you're wrong really anywhere on the table. I agree that those are all issues that we need to keep in mind. I'll tell you a couple that I really think could be an issue there. The Federal Reserve, I believe that we're going to have a pullback at maybe not 20%, but around 10%. Market overvaluation, that won't be for a couple of years. So I think I'm looking longer term at that, and we'll have a pullback.
So you like this October 19th, 2017 number?
I got to tell you, 3 years from now, October, month of crashes, we could see a crash at that point. You know, Charles, people always say we can't be up, so many weeks in a row. S&P came in this week of 5 weeks in a row. 5 times in the last 5 years or 9 times in the last 5 years that happened. 12 months forward from there, the last 9 times, market's up 14%. So we could be up 5 weeks in a row. We can go 500 some days with that 10% correction. We can go much higher.
What's scaring you on that list?
Well, I think the list is good, but I would add a couple of things here. I would add earnings. And you got the economy there, but earnings impact. We're talking about high earnings and profits for corporates in America.
And margins. People argue that margins can't get any better.
They cannot get better. Maybe. So that's, I think, a risk out there. And also, I think the European economy, what happened last week where I'm with you, Dani. Where they actually got very low. It did help the market. It helps the market. Not Greece. No.
Here's the thing. I think earnings, we keep saying you can't suck blood from a stone, but they keep doing it. So I don't worry about that as much. And I tell you what, Charles, I worry about ISIS. I think ISIS is an issue. I think we're not giving it enough. We're not giving it enough attention.
You mean like, hold on one second, Harley, let me ask. You mean like, for instance, like one of these guys goes over there, comes back here and blows up a mall, something like that?
Yeah, I'm saying it could happen. It could happen any day. It could happen.
And I agree with you. That would be more of a 10% impact.
Yeah. Absolutely.
Okay,
and that's what I'm saying.
But that's unexpected terrorism, which is a different category. The Fed has to yell fire.
It's on the list.
The Fed has to yell fire in a crowded room. That will bring down the market. It's not going to happen for a long time. Rates aren't even going to start going up until the second quarter.
But the market will anticipate the Fed hiking rates. It's not going to wait until they actually hike them. Once you're done with quantitative easing, which is in a couple of months, then the market will become oversensitive to economic data.
Right.
But the Fed has really been managing expectations well. The bottom line is what Matt said is on the money. The bull is continuing to run and will continue to run. We are not overvalued. The issues out there are not strong enough to bring us down.
I'm with Dani. I think Europe is, everything on here I agree with. I think Europe
brings the money to the U.S.
Let her finish,
I would say that it's going to have a longer term impact, and it's going to be even more. It's going to be a little bit more than 20%.
Really? Mm-hmm. Wow. All right, guys, that was great.